Hello and welcome to another episode of FinTech Focus TV with me, Toby Babb. And today I am absolutely delighted to introduce you all to Yash Patel from Telstra Ventures. Yash, how are you?
I'm doing great. Thanks for having me, Toby.
Listen, absolutely fantastic. I'm really looking forward to this conversation. Been having a bit of a preamble beforehand, but a super exciting space at the moment in the venture world. There's a lot going on. 2024 is a year where I think we're all agree there's a hell of a lot of opportunity within it. Um, I read your musings for fintech in 2024, and I agree with a lot of what you're talking about all the way through it. I think this is there's some various people have spoken to me about it being a sort of generational time of technology sort of colliding at the same sort of stage as evolution. And I think in the financial markets, the fintech markets as a whole, there's this wonderful opportunity at the moment for people to come in there and prosper. So you used the word cautiously optimistic earlier on. We'll explore that a little bit later, but I share that cautious optimism, probably a little bit more on the bullish optimism on my side of it. We'll explode that later. But before we do all of that, Yash, can you tell us a little bit about your background, yourself, and then introduce Telstra Ventures to us as well?
Yeah, absolutely. Happy to do that. So my name is Yash Patel. As you mentioned, I've been a partner at Telstra Ventures, a general partner for 10 years now, really focusing and leading a lot of our consumer tech and vertical SaaS and sort of consumer fintech investments. Really, my background is I started off as a lowly but hardworking, industrious investment banking analyst at Jefferies over here in Silicon Valley. Ended up joining a tech startup in the advertising technology space that was venture backed by a lot of big growth funds. And then ended up joining Telstra Ventures to help start their efforts over here in San Francisco. Fast forward to today, this was back in 2014, January 2014, when I joined Telstra Ventures. We've built a really great fund, and we feel, we're doing some great things. And so the best way to think of us is we have about just under $1 billion in assets under management. We closed our most recent fund about a year ago, a $350 million fund, really investing kind of at that Series A and B stage, post product market fit inflection is what we like to say. I try not to get lost in the semantics of what an A or B is, but really it's call it $1 million in ARR or $1 million in kind of transactional revenues, depending on the business model, kind of really seeing inflection. And really where we can provide not just capital, but our other resources of our firm. And I'll touch on that in a second, but we try to differentiate beyond kind of capital, which we feel is increasingly a commodity, with helping with things around sort of recruiting, sales prospecting for a lot of our enterprise customers, opening up international geographies, such as Australia, Asia Pac, where we have a lot of relationships. And then also taking a very quantitative approach around not just deal sourcing, but value add post investment. So we have a data science team that does wonderful work with us to help augment us as investors and give us superpowers. And then by proxy, also give superpowers to our portfolio companies. And so we feel that it's a really interesting combination of these three kind of elements, capital, data science, and sort of value added relationships on the revenue side that move the needle beyond kind of our good looks. And so that's been pretty exciting for us moving forward. And so, as I said before, we focus on a lot of sectors: climate tech, fintech, which I specialize in, consumer tech, DevOps, cybersecurity. But we try not to kind of boil the whole ocean. We try to be very thematic and then combine that with a lot of quantitative research as well.
It's a really interesting sort of take on all of that, and there's a lot to unpack from what you've just said. I want to go. I mean, you've got some stellar names and some really successful forays into the fintech world as well. Do you want to talk through a couple of those and?
Yeah, absolutely happy to do that. We've got some later stage ones that are doing some great things, and some earlier stage ones. Just more generally, we've done some great things. Some names you might recognize on the cloud software side include DocuSign, on the cloud storage side, Box, Snapchat on the consumer side, CrowdStrike on the cybersecurity side, GitLab on the DevOps side. So a lot of really interesting names. And then specifically as it relates to fintech, we've had some really good successes with a few companies. One is in sort of the vertical government tech space, which is a company called OpenGov, which sells cloud ERP solutions to local, state, and federal governments. This is a later stage company. We invested at the Series A with a few other investors, including Andreessen Horowitz. Really excited about what they're doing. We've got another company called Super.com, which is a pre-IPO company, which is basically creating a savings super app for lower FICO score consumers here in the United States. And so that's been a really exciting, sort of business, really playing on our theme around kind of the super app concept that we've seen in Asia when you kind of think about WeChat, or in Southeast Asia when you think about Gojek and Grab, where you sort of see fintech meets commerce and on-demand services. And so we haven't seen that necessarily in the Western markets or in the US as well. And so we're excited about what these guys are doing in sort of this vertical around savings and helping build kind of credit for some of these folks that are, not frankly kind of served by the traditional US financial grid. And then we've got a bunch of others as well. I could kind of rattle on at the earlier stages, but I'd sort of say we're very excited about investing in financial services that are being democratized for the underserved, and that kind of touches a lot of areas that I can kind of go into later as well.
Yeah, and when you talk about that sort of stuff, I think it's really interesting about how you choose and where you're pointed and what sort of things are really interesting to you and to you as a business, because every VC I've spoken to are definitely not short of people there who've got great products who are knocking on the door, and yet the amount which you're actually physically able to invest in over the course of it sort of make it a very competitive field. And I find it really interesting about how someone stands up to how you partner. Now, you mentioned there that this isn't just about the money, right? Which I think is really important. And I think the approach to partnership with a VC is incredibly important, because as you said, when you've partnered with other companies where you've got founding team who are in there, if those teams are all slightly different in what their ambition is and where they want to go, you end up with with real problems about what that can look like, and whose agenda is what, etc., etc. But when you're there and you're talking about adding more value, which I think is really important, and increasingly getting better, where it's not just right, here's the money and we'll wait and expect to hear X and Y and Z and this sort of return by that sort of stage. But you're talking there about recruitment, you're talking about sales strategy, you're talking about go-to-market, etc., etc., which becomes genuine partnership. And with genuine partnership, there needs to be that sort of marry up. So what are you looking for when you're talking to, obviously you're looking for companies in the sort of, when you say quantitative sort of approach to it all, you're looking for the right numbers, you're looking for the right, Series A, B. You've got a story there which is, I guess post validity about what and where it goes, etc. So there's elements there around it, but also, and I know you'll be looking at team and people, etc., etc. But there's also going to be something there about having the same sort of ambition as to where you want to go. So when you're doing that, what do you look for in that sort of partnership?
Yeah, it's a great question. I'd sort of say, just taking a step back, while we invest in technology startups, we are investing in people first and foremost. And so everything we do around data science really helps us identify the best people and the best teams. So lighthouse entrepreneurs that have sort of strong conviction in a market that they're going after in terms of disrupting, whether it's an antiquated, government tech sector, or it's an antiquated kind of farming sector, or it's an antiquated SMB kind of play in e-commerce. There's a lot of kind of sectors that we do generally have a good field for in terms of our knowledge, but we really are betting on people. And so for us, when we are looking at evaluating these companies, and frankly, this is a partnership, we really want to ensure that these folks have the ability to kind of scale up their teams, hire people that are smarter than them. That's really important from our perspective. Two, are they kind of able to tell a narrative or story that can kind of resonate with customers as well as future investors further down the line? That is actually a very important part of the business. It's not just metrics and kind of hockey stick growth that you see on a chart, but you need to be able to sell a vision, and that's equally, if not more important, if you're an enterprise software company selling to large corporates as well. And I'd sort of say, I think one of the most important pieces as an investor is, we want to make sure that we align and have conviction around what an entrepreneur is going after, but at the same time, we do want to have some flexibility there, right? Some of our best returns, our outlier returns, come from sort of investors where you kind of have, sort of give them, the entrepreneurs, a bit of freedom and let them go after certain sectors that may not make sense to the rest of the world, right? It may seem irrational, but to us, that makes it a ton of sense, right? When we see outlier returns, we find that, it doesn't actually, many cases, make sense for, the average Joe. And so, there's a careful balance there between, making sure that you align completely with an entrepreneur in terms of their vision, and also, having that natural tension over time, right? This is a 5, 7 year hold we're talking about, right?
Yeah.
So companies go through roller coasters, and so you're going to have sort of naturally differing opinions. And we just want to ensure that we are able to work together, like in any partnership, and encourage our entrepreneurs to be creative and go after areas that we as investors may not even fully appreciate at the time.
So that's a really interesting piece, isn't it? In more than one way, because it's the same. Look, I've been in the recruitment industry for 24 years, and I know that there's not a precise science to it. So no matter how dead cert a hire may look on paper, you're still talking, even in the best processes, of of a matter of hours of time with people from both, and this works on both sides of the coin, right?
Yeah.
And you're making multi-million-pound decisions based on, I guess, a little bit longer and a little bit more due diligence on the whole process, but it's still investing in that individual and in that person. One of the interesting words that you just used on this was data science and taking a data-centric approach to people, which on a people basis is always quite tricky, because you're talking about entrepreneurial talents and personality there, which on a data perspective is not as easy as to gauge as performance and numbers in, numbers out, etc. So talk to me a little bit about, because as much as anything, this is a recruitment process for you as well, I guess. So
Yeah, absolutely.
tell me some of the things that you've seen as significantly stand out in that whole process, and what allows you in the process that allows you to make the best bets that you're doing into those
Yeah.
businesses.
Yeah, it's really interesting. So we take both a qualitative and quantitative approach around
Mm,
evaluating people. And so what I mean by the quantitative approach is there are certain signals on the web that we can kind of collect, things like Glassdoor reviews, reviews around culture, that are sort of simple. You kind of caveat that with, the size of the sample size that you got, et cetera. But there's a lot of publicly available data and privately available data that we actually procure around a lot of these folks. LinkedIn data, as an example, understanding the backgrounds of these entrepreneurs, people that we know in our network that can kind of validate these entrepreneurs. So we do a lot of reference checking with a lot of
hmm
these entrepreneurs. But I'd say the more interesting piece is actually when we meet them in person. For every single investment that we do, I like to have a personal one-on-one dinner with these entrepreneurs, not just once, but several times. And for
mm,
me, I kind of joke that sometimes I feel like we're playing psychologist many times, because
100%.
we need to evaluate the ability for this entrepreneur to scale, hire the right people, people smarter than them, and know to make the right decisions morally, ethically, and also just from a fiduciary duty perspective. And
Mm.
so for us, that's not quite able. That data science or AI will never fully be able to evaluate that at least at this point in time. And so that's the human brain effectively. And so we
It's
spend
the
a lot of time just not just with myself, but my other partners, coming in and just chatting, both, personally as well as professionally, with these folks. And I'd sort of throw in one interesting signal that I've found is, I think when we source deals, it's great to get referrals from your network of,
yeah.
seed or pre-seed investors. One of the interesting signals I've found personally is I like to reach out to entrepreneurs, or cold email them. And many times, you may not get a response. The
Yeah.
ones that do respond are actually the ones that end up having better returns. And I've got to pull up the exact data, but
Is that
it's
right?
an interesting signal that shows that those entrepreneurs are more open, more creative, and actually willing to, not just accept new investors, but maybe be more
Have the
open to new
conversation.
partnership. Yeah,
Yeah.
conversation on the product side, the partnership side. So it kind of also kind of foretells their ability to kind of be creative in other parts of the organization. So it's an interesting kind of anecdote, but I
Yeah.
think we've got some data behind that
Yeah,
around
well,
cold
I
emails
love that
versus
sort of
networking.
mix, that mixture of both. There's data, but there's intuition, and I think that's in a world of AI, I think that human and machine working together to make better decisions is incredibly important. Um, I'm interested to sort of pull on the thread of the dinners that you're talking about. So, A, for a man who's constantly having dinners, you're looking in great shape for that. But B, um, the tell me a little bit about the concept of what you're looking for. What are some of the things that you look for when you're sat opposite someone? And you mentioned something really interesting there, like the ability to to recruit people who are better than them. In those conversations, what do you see as some of the traits that allow people to do that, to hire people better than them, to be open to
Yeah,
that sort of concept?
it's a great question because I think for the most case, we see a lot of driven, passionate entrepreneurs. The areas that we like to also focus on are around empathy, humility, and coachability, right? And
Yeah.
not so much coachability from ourselves, but are there other industry experts in the in sort of the operating space that can come in and help, provide input or be a sounding board for these entrepreneurs around the kind of executive coaching piece? And that's an area that I think is really important, and not so much executive coaching coming from investors, but executive coaching coming from other peers in the industry that those founders are very much respect. And so we find that if you're a bit too headstrong, that actually can work in your favor as an investor in terms of outlier returns. We've seen some great examples of that with Snapchat,
Mm.
Evan, and Uber, if you're an investor in them, with Travis. But for the vast majority of cases, we sort of see that coachability and being open to input not only helps with sort of scaling a business and scaling your own kind of qualities or kind of skills as a company goes from 5 employees to 100 employees to 500 to 2,000.
Mm.
You naturally are going to need to kind of up your skills. And some entrepreneurs are open to coaching, others are not. But we found that the ones open to coaching are also the ones that respond to cold emails,
Yeah,
surprisingly.
it's
And
incredible, isn't
so
it?
it's really interesting to kind of see that pattern recognition, when we're sort of looking at making new investments.
And when you're looking at those investments and you've done the partnership, and you mentioned beforehand about sort of being able to help with the recruitment aspect, etc. What do you bring to the table on that front? How do you help? Because one thing we do know is that Series A and Series B, the failure ratios of those first CROs, etc., are phenomenal.
Yeah.
And those go-to-market teams of that decision being the wrong decision after that money's been going through are, again, I haven't got the data to hand, but it is a striking figure of those go-to-market teams not being the right ones from the get-go, which I guess is a massive, massive win for you if you're talking about percentages and accelerators, etc. Having that right CRO, having that right sort of senior team, the right product team, the CPO you might be bringing in at that sort of stage, CTO, whatever it may be. How do you guys engage to help get those entrepreneurs get that right? And as you say, the all important part of it is surrounding themselves with people there who are going to be, who add real value and be better than them in many ways.
Yeah, we've made 98 investments, to date. And so we have a
Yeah,
really
well,
strong network of CROs, CEOs, and CXOs in general that we
yeah.
tap into to provide advice. And then also over time, if it makes sense for both parties, to actually join them in a full-time role. And so we get very surgical around, which companies we partner up with some of the folks in our network, because what we've seen, to your point earlier about the failure rate at the Series A to Bs, going from 1 to 10 million in ARR is very different from 10 to 20 million, right? So
Absolutely.
we've sometimes seen larger corporations with execs that have done very well that sort of have had, 20, 30 SDRs and 28 account execs come in at the 1 to 5 mil ARR kind of stage and not see success because they sort of aren't sort of attuned to basically rolling up their sleeves and sort of are better at the later stages. And so
Yeah.
we're very sort of careful to ensure that, the people we bring in from A to B are very much, sort of able to kind of scale with the more lean resources, and basically, not require an army of, 20 SDRs to kind of achieve their kind of metrics.
Mm.
That optimization of kind of SDR to AEs, to, kind of customer success folks as well, usually happens at the B, C, and D stages, and we see a lot of success with those type of execs. So we're very surgical. Similar kind of sort of thoughts around chief product officer, chief technology officer. So we tap into our network of existing entrepreneurs as well as other investors that we know very well to kind of match many of these founders up. The other piece that I should mention is we do take a very data science approach around kind of crawling kind of LinkedIn and understanding what types of personas could be interesting for some of our companies. And then we'll kind of reach out to them and say, hey, we haven't met before, but we have a very interesting company based on your experience scaling X, Y, and Z company from 1 to 5 mil ARR that could be of interest to you. And in many cases, some of those people are also sales prospects as well.
Mm.
So it kind of goes hand in hand. And so our data science team has done a phenomenal job of helping our portfolio companies when it's requested, right? So not every company necessarily needs that level of help, but when they do want to opt into it, we are able to provide those resources both from a data science perspective as well as from our network, of 98 plus portfolio companies and beyond in terms of other investors and folks in the ecosystem.
It's such an important thing to get right, isn't it?
Absolutely.
When you're at that sort of stage, I think it is the pivotal part, when you're at that sort of bit. And as you say, that there are different people. I think this is the thing that gets lost. Sometimes people see someone who's taken it from here to here and the skill set is completely different. And having that sort of, to me, it makes absolute sense. Having a company that's put that money into your business who wants you to be successful and has gone through that 98 times, as you say. Yeah, and I guess that comes back again to that coachability aspect. It's so important to listen to that and look for that support and look for that help. And I guess, when you're talking about that test of just reaching out via LinkedIn or an email, etc., and seeing how they respond to it, it all ties together. It's clever stuff, right? In terms of
Exactly. It's
how it
one
works.
kind of data point that feeds into it. So, at the 1 million ARR stage, you're either selling or buying.
Yeah,
There's
yeah,
no other kind of role at that stage. Or
yeah,
sorry, selling or building, not buying.
yeah,
But selling or building, if you're doing one of those two things, you can add a lot of value. And so
yeah.
that is what we look for in terms of recruiting and helping out our companies at that A kind of B stage.
Yeah, fantastic. I wanted to move into as well about, we mentioned you being cautiously optimistic. You also said to me that 2024 investments is one of the most exciting times we've seen in quite some time, which is something that's been echoed to me numerous times by numerous different people in your space. So there's this, there's this sort of growing phase at the moment. Now, the cynic would say that it's because it sort of favors one side rather than the other at this sort of moment. I think everyone was getting very excited in 21 when the valuations were very much in favor of the founders who were sat there with these ridiculous valuations. I thought that was always dangerous, right? Because it was driving an unreal marketplace, and you saw money going into businesses and ideas that I never thought should have been at that sort of stage with valuations that were way over the odds. To me, it's exciting because I think this means a lot more sustainability in terms of those investments that are being made. And I'm imagining that's probably where you come from when you make that statement. But I want to unpack that a little bit and understand why you feel that 2025 is as exciting as it is. Where it comes from, this cautious optimism comes from. You mentioned IPO markets and various other parts in this as well. But why are we in such a great moment at the moment? For both sides? Because I think both sides have to win in it. That's the piece.
Yeah.
And to me, I feel that's where we're heading at the moment.
Yeah, absolutely. So look, stepping back for a second, 2021 was a very much kind of ZIRP environment, zero interest rate kind of type of environment where free money was in abundance.
Mm,
And for most tech companies and tech startups, they got a little bit lax around very important kind of metrics that we look at, right? It wasn't just LTV to CAC, lifetime value to customer acquisition cost ratios, but it was payback periods that were very much ignored in 2021, right? So instead of taking, maybe 6 months to pay back the cost of acquiring a customer for a fintech company, it might have been dragged out to 12 months to 18 months to 24 months. But it was fine because there was so much free money available that you could continue feeding that machine. Fast forward to 2022 and 2023, that macro environment just completely shut down. Credit got very tight. And
mm,
that had a big effect on many of those companies that had fine-tuned this machine around payback periods that were frankly 12 to 24 months, if not longer, and not sustainable with short money, right? With little money available, to kind of finance that. So the companies in 2022 and 2023 that quickly pulled back and figured out their payback periods and also their unit economics in a very disciplined manner and did that thoughtfully and did that sooner, frankly, rather than later, were the ones that ended up not just surviving, but what we've seen in our portfolio, and I'm sure the venture ecosystem more generally, end of 2023 and 2024 have been the ones that have been thriving.
mm.
And that is interesting when you kind of think about for 2024 and beyond, as I said before, we are sort of cautiously optimistic from a macro perspective, right? The U.S. Fed has indicated that there likely will be rate cuts later this year and into 2025. Question is not, if, but when.
Mm.
And so for us, we think that this is sort of a fleeting moment in the sense that, we can kind of still invest in these companies at the Series A and B, get 10 to 20% equity at sort of more reasonable valuations before we might see another run start to emerge. And, I'd sort of say that's the broader kind of more general tech ecosystem. AI is a totally different space in terms of valuations and the hype cycle there. That's kind of, very much not correlated to the macro that we're looking at right now. And so we've been very cautiously optimistic around AI more generally. But for us, this cohort of investments where you're coming in at reasonable valuations and frankly, a mindset from a lot of founders because they've got a lot of scar tissue from 2022 and 2023 that unit economics are important and most importantly, payback periods are important, especially in consumer fintech, is really interesting. And then the final piece I'll mention is, Coinbase's stock has, been on a tear in the last year, up 120%. Even Robinhood has more recently kind of, increased. Many of these public stocks were battered from a valuation and multiple perspective in 2022 and 2023.
Absolutely.
And so if we see some of these public comparables or public comps start to kind of increase in terms of their valuation, that will trickle down into sort of the private markets and the venture markets. And so for us, it makes it easier for us to underwrite investments if we see that some of these public comps are actually trading at more reasonable revenue multiples, right? Instead of 1 to 2x, kind of forward year revenues, they might be trading at 4 or 5, even 10x, depending on the company we're talking about. So that's kind of a market change from 2023 and 2022 as well.
Incredible, isn't it? I think it sort of creates this, as you say, this sort of bubble at the moment where there's a great time on, for everyone to win in that sort of space. And moments don't last forever, do they? In terms of where it goes, there's always something that goes on. And look, we all know that even the best economist in the world is getting things wrong at the moment in terms of where it goes. There's so much volatility. But I think when you look at that and you were talking beforehand about what the best companies were doing in 2022 and 23, where you were seeing so much attrition and so much, as people who were the victim of the volatility as opposed to the people who were able to navigate that. That sort of, I think sharp business focus makes real businesses, what I call real businesses, focused on profitability and sustainability and building good products into good marketplaces with scale, et cetera. That's the golden ticket, and that to me has always been where money should be invested at the same sort of time. So it feels like an opportunity for people to get it right at the moment and lose that sort of burn rate of bad investment at the same sort of time.
Yeah, absolutely. And I think in 2023, the rule of 40 was popularized. Basically, effectively, if your growth rate plus your EBITDA or net income margin added up to 40%, then public market investors would likely reward you well. And this is mainly for pre-IPO companies, later stage companies. And so that kind of rule of 40, I think, has been kind of been sort of that mentality has been pushed into a lot of founders' mind, even at the earlier stages as they think about their scale. When they hit the C and D, we need to have that sort of profitable growth engine moving, not just 3x year-on-year growth, but maybe let's grow 2x and have a little bit of a path to profitability, right? And that becomes easier for public market investors to get comfortable from a valuation perspective, if that's what your end goal is. The other thing I'll mention is, for us, investing at the Series A and B, to your point, we are not economists, and even the best economists, it's tough to predict the future or the unpredictable. And so for us, we have a 5 to 7 year hold, if not longer in some cases. And so for us, we focus on builders, and a 5 to 7 year hold is a long time, and the macro environment will likely be very different. Yeah. And so we tend to focus on kind of the IPO markets and public market kind of evaluations for many of our later stage companies that we're looking for liquidity from at some point in the future because we've held them for 5, 6 years. But for the majority of our portfolio, they're still early and young. And so we're really excited about what this looks like in 5, 6, 7 years, and how tech trends, whether it's AI, whether it's, a whole bunch of other kind of trends that we're monitoring, affect our companies, both positively and negatively. So we spend
Mm,
a lot of
mm.
time talking to builders and developers and folks of other founders that are in the ecosystem that are predicting, more from a technology perspective, what 5 years looks like as well. So I'd say that mentality, along with kind of the financial markets piece, is pretty important as we underwrite new investments.
So what does 2029, 2030 look like?
I let me just put it this way: Skynet will not be formed. But look, I think for us, AI is a big, big kind of trend that everyone is talking about, and we've been very cautiously opportunistic around that because we worry about valuations. And frankly, we think a lot of the value may accrue, especially at the foundational model layer and the infrastructure layer, to the Googles, the Microsofts, the Metas of the world, the NVIDIAs of the world. You saw ARM Semiconductor over in the UK up almost 40-50% yesterday with a 14% beat on their kind of revenue projections.
Yeah.
So there's clearly a lot of value accruing to the big players that will facilitate a whole new world of AI. We tend to focus more on the application layer. We think it's really interesting. As an example, I'm looking at a company that's sort of an AI co-pilot for accountants, right?
Okay.
We've seen a lot of AI co-pilots for the legal services industries, but can accountants at the Big Four, KPMG, E&Y, become more efficient with an AI co-pilot to help with these audits and other services they're providing? So that's just an example of AI in kind of one space, but we see automation of a lot of tasks that consumers in the financial services space are doing right now, whether it's optimizing for your future net worth with tax optimized investment accounts, or it's doing your taxes instead of using Intuit or TurboTax. Can this be done through AI in a more efficient manner? There's a lot of startups within our portfolio and outside that are attacking different kind of areas of that ecosystem. So we get excited about a lot of areas. I could go on forever, but I'd say those are some of the top areas right now.
There's definitely gonna have to be another show, Yash, for this one. I feel a follow-up coming on, a sequel.
I'm happy to do it. I love it.
I want to talk a little bit about the musings that I read from you when we were first introduced. So there was various thoughts on what it looked like in the marketplace. So quickly touch on that for me. If you're, this is your space, your world. You're the fintech expert over at Telstra Ventures, and you're looking at this industry. So what's exciting for you? You've mentioned AI, which is obviously on at the forefront of everyone's thinking at the moment, without question. But
Yeah.
there's also a lot of other generational movements that are happening to sort of across every single area of, because fintech's such a broad area, from capital markets all the way through to payments, through to everything else that you can look at within it. Tell me where your bets are, what's exciting you, where you think what do you think the big macro trends of 2024 will be in the fintech space?
Yeah, absolutely. And it's sort of interesting because, as I said before, consumer fintech in particular has been battered and it wasn't in vogue. But I think there's a few trends right now that are making it pretty interesting. And one I'd sort of say is around sort of wealth tech or sort of wealth building. And we've seen a lot of great businesses, whether it's Betterment or Wealthfront, that focus on providing wealth building services to high net worth individuals, typically older individuals. But we haven't seen those services democratized for the masses, and in particular, Gen Z and millennials. And so for us, we sort of see that there's this movement of, younger folks, they might be making 100 to 200K, they might be working as an engineer at Google, they might be working as a salesperson, solid income, but they don't have the same level of attention from the JP Morgan Chases, the Goldman private wealth management folks, or the Betterment or even Wealthfront, kind of the fintech guys in wealth tech, in terms of catering to their needs as they kind of grow their wealth. And so, we've seen a lot of focus, especially in 2023 and 2022, to move away from, meme investing and cryptocurrency investing by a lot of younger folks to actually investing in fixed income or retirement accounts and just building long-term wealth, things that, your parents might have told you, my parents told us, but weren't totally embedded in our minds because there wasn't a digital interface that was easy to work with, or there wasn't a lot of automation. And so one of the things that's interesting for us is, in the US, 401k kind of fund, retirement funds effectively are offered to all kind of workers, or the majority of workers, and only 41% or about 40% actually contribute to one. This is free money people are kind of giving up. And so there are a lot of fintechs that kind of help people not just educate them around kind of wealth building for the future, but actually automate this, connect your accounts through Plaid, and actually automate this on a monthly basis. We have a company called Playbook that we led a Series A in last year that is working on precisely this. So I'd say that's one trend that's really interesting for us. The other is around sort of this concept of super apps. I kind of talked about it earlier, but we've seen kind of the convergence of e-commerce and kind of fintech happen in many Asian countries, right? Whether it's Gojek or Grab in Southeast Asia, Indonesia, or Alipay and WeChat in China, or Reliance Jio and Facebook and WhatsApp and that kind of whole investment JV that's set up in India. But we haven't seen that in the West, and we're seeing a lot of larger companies like X, or formerly known as Twitter. You've seen they've just recently launched peer-to-peer payments, or announced that they will
Oh,
launch
that's
them.
always been their sort of agenda, hasn't it? When you look at
Exactly. So Elon Musk is sort of executing on this play to kind of create a super app using X, starting with peer-to-peer payments and then moving into other commerce opportunities. And that's sort of on the larger side of things. But we see more smaller verticals in the US, in particular, sort of the savings, cashback, reward space, that you could kind of see other super apps emerge. And one of our companies, super.com, pre-IPO company doing great, is really focused on helping low FICO score people build credit through this credit card, effectively a debit card that acts as a credit card and helps them build credit by using this credit card in their own ecosystem of kind of travel and e-commerce. And so they get cashback rewards. And so this concept of kind of cross-pollinating e-commerce users with kind of building credit through this kind of credit card product is a super interesting. So that's kind of another trend. And then the final trend is a bit more, I think it's controversial in the sense that we've seen a lot of disenchantment with sort of Web3 and blockchain after a rough kind of winter in 2020.
Definitely, yeah.
And so one of the things that we monitor from a data science perspective is core blockchain activity on GitHub repositories. And we never saw that kind of activity actually dipped as much as kind of crypto investor speculation dipped. And so with sort of crypto prices, they've performed phenomenally well, better than tech equities in the last 12 to 18 months, resurging. And you're sort of seeing steadier macro conditions and more kind of clarity around the regulatory environment, especially in the US, and then sort of the launch of these Bitcoin ETFs. We think that there could be an interesting resurgence of kind of real Web3, Web 2.5 kind of businesses that have real revenues, like real ARR, and are monetizing, that could be more sustainable into the future. And so I think they've learned their lessons. They've had a lot of scar tissue. They're not just going to issue tokens and try to, effectively create something that doesn't solve a problem. But there's real kind of adoption from the large brands, whether it's Starbucks and their rewards program and sort of the Nike tinkering with NFTs. That could be really interesting with this resurgence of crypto prices moving forward.
I think it's so interesting you say that, because we've been banging that drum for some time, that actually that crypto winter is kind of something that had to happen. For it to become for it to become a credible asset class, it almost had to go to the wire to grow it up and to make it as trusted. That was the big piece that was missing in the whole Web3 and crypto world, and in digital assets world, should I say, more to the point, was the trust element. And as you've seen an institutional move into the space and this convergence of centralized and decentralized finance, I think that creates a real exciting opportunity in it as well. So very much on the same page. And this is what we're talking about, right? There is a wonderful culmination of so many different areas of both game-changing technology, from AI through to blockchain and everything else in between it, alongside these sort of generational moves where you can see real opportunities to do a financial ecosystem in a completely different way, that's led through digital innovation, that's led through customer-centric plays that allow things to be better. So I'm really excited about what it looks like and where we can go with it all.
Yeah, absolutely. And I throw one more in there. The intersection of vertical SaaS and fintech is really interesting to us. So as an example, I have a health and wellness company that is doing a lot around kind of digital workouts and helping, with physical therapy. But they've launched a flex card that effectively allows their users to use, kind of this card, this flex card on kind of benefits that their insurance company provides. And so Is this a fintech company? Is this a health and wellness company? It's all kind of converging. And we've seen that in other industries, not just health and wellness. But I talked earlier about OpenGov and sort of the cloud government kind of ERP space, selling
Mm,
to local, state, federal governments. They've got this budgeting and this budgeting module that citizens can see when legislators or kind of lawmakers are putting together budgets for different constituents. And, a lot of that is, kind of opaque, but, is this an ERP kind of a transparency solution, or is this like a cloud solution for governments to kind of be more efficient? Is this more like a DocuSign or Box? I don't know. It's all kind of converging, but fintech is a big part of that as
yeah.
well.
There's massive opportunities. There's a couple of companies I think over here who are looking to IPO over the course of this year. The London Stock Exchange has obviously been hammered over the last 12, 24 months or so. But there's a couple of tech unicorns that I think are sort of looking to do something quite special this year. And again, it's in those sort of areas you're talking about, which gives when we talk about the broad nature of fintech and what it looks like, actually, I think it continues just to expand, as you say, and where does the door stop on it is a different question altogether, isn't it? But it's one
Yeah.
thing's for sure, it's a really interesting time. Yes, I could be talking about this forever, and I knew this was going to be one of the ones where I wouldn't be able to keep it to half an hour, but I'm really pleased that we've sort of extended it out a little bit further. And definitely, this is a sequel episode for sure. There's a couple who I go back to every single year and get the temperature check on it all. So I'd love to throw you into that category as well, because I think you've got real value to what you're talking about. But let's finish with who should be reaching out to you. What are the sort of companies who you're interested in talking to at the moment? Yeah, I know you reach out to them, but tell me, how can they reach out to you? What's the best way to reach you? Who do you want to hear from right now?
Yeah, look, companies that are sort of past that post-product market fit inflection stage, usually, about 1 million in ARR or transactional revenues, kind of growing 3 to 4x. That's right in our sweet spot. We can add a lot of value. We can co-lead or lead investment rounds anywhere from $5 to $10 million. Equity checks is really our sweet spot. And, to reach out to me, it's very simple. It's Yash, YASH, at TelstraVentures.com. So please send any information, or just reach out for a coffee at any point if you feel like you fit that kind of criteria.
Absolutely fantastic. Listen, it's been an absolute pleasure talking to you today. Thanks so much for coming on the show and sharing the wisdom. Really good to meet you. Really good to talk through. Thanks for coming on the show.
Yeah, thank you, Toby, and look forward to joining you on the sequel.
Absolutely. And thank you all for watching. We will see you soon on another episode of FinTech Focus TV.